There's nothing fiscally responsible about waiting to fix your roof until it caves in. We've got a lot of deferred maintenance in this country. We could be putting a lot of people back to work.
That was President Barack Obama in a press conference this morning, making the case for more bipartisan coordination in order to stimulate the U.S. economy. And just this afternoon, S&P reaffirmed their AA rating with a continued negative outlook. Our next guest believes the U.S. is at risk of runaway debt, rampant inflation. For more on this outlook, we are joined by Peter Schiff, CEO of Euro-Pacific Capital and author of The Real Crash, America's Coming Bankruptcy. Peter, thank you for being on Market Sense today.
Thanks for having me on.
What do you believe with respect to President Obama's thoughts about the lack of bipartisan support with respect to the job stall in the United States?
Well, I'm glad he's not getting a lot of support, because then he would do even more damage than he already is. You know, more spending of borrowed money or printed money is not going to solve our problems. That's the source of our problems. You know, if you look at Ben Bernanke's testimony yesterday, I think it was really revealing in what Ben Bernanke told one of our senators, DeMint, in response to his question. And maybe he read my book, because it's basically the premise of my book. He basically asked about the real fiscal cliff. He said, what's going to happen when interest rates rise? We've got all this debt, and if interest rates go up, how are we going to afford to service it? And basically what Ben Bernanke said is, don't worry, because even if interest rates go up to 1%, that's only going to add about $100 billion a year to the cost of paying the interest on the debt. To me, that seems like Ben Bernanke is committing to, under no circumstances, raise interest rates above 1%. I mean, 1% was the lowest they got under Greenspan. That's now the ceiling under Bernanke. No matter how bad inflation is, no matter how weak the dollar gets, Ben Bernanke is going to keep interest rates below 1% indefinitely, because he knows that if interest rates go up to a normal level, the U.S. government's going to have to default. I mean, was S&P even listening to that? Because what he's basically saying is it's either default or inflation. And if that's the case, our bonds should be rated junk, not AA+.
But a year ago in the United States, you had political gridlock. Now you've got double gridlock, given that the Tea Party is now impacting the Congress. So if you're going to have such political gridlock, what's Bernanke supposed to do?
Well, what Bernanke is supposed to do is raise interest rates right now, let interest rates go up, so that he's no longer an enabler of the problem. If interest rates were allowed to rise, which they need to do to restore a balance to our economy, that would force Congress to have to make significant cuts. And the only reason they don't have to make those difficult choices is because the Fed is giving them an easy way out. But we're making a deal with the devil here, because eventually rates have to go up, and the more money we borrow while rates are cheap, the harder it's going to be to service it when rates go up, because we're borrowing in the Treasury bill market. Contrary to what Bernanke tried to tell Senator DeMint, we have a lot of short-term debt. A lot of it comes due in the next year. We are very exposed to an increase in interest rates, and Bernanke knows it. But the biggest structural problem with the U.S. is that interest rates are too low. That's why we don't save enough. That's why we don't produce enough. That's why we consume so much. That's why we had a $50 billion trade deficit in the month of April, which followed a $50 billion trade deficit in the month of March. I mean, we're borrowing an enormous amount of money because our economy is so imbalanced because of all this cheap money.
But, Peter, what would happen to the housing market, which some would say is just starting to recover ever so slightly, if, in fact, you raise rates, as you're suggesting?
Housing prices are going lower. I mean, I think this recovery is phony. Look, I just testified yesterday in front of a House Congressional Committee on housing, where the U.S. Congress is now thinking of even more subsidies to guarantee mortgages on multifamily homes through the securitization processes, putting federal guarantees, more taxpayer money at risk, compounding the mistakes that they made with single-family home. It's amazing that Congress still doesn't understand the moral hazards and their culpability in inflating the housing bubble. But if you really want to see the testimony, and listen to me, I mean, it's on YouTube now. We're putting it up on my YouTube channel at YouTube youtube.com/Schiff report. I got a 35-minute excerpt of my back and forth with Congress, or you can watch the whole 2-hour hearing. But everybody else is a lobbyist, basically trying to get more money out of the U.S. taxpayer. I'm the lone voice of sanity trying to represent the taxpayers who are getting ripped off by the U.S. Congress.
I do want to see that, and I will watch it. I guess I'm wondering as well, what do you think the solution is then in terms of the housing market? What are you hearing is going on behind the scenes? We talk a lot about this shadow inventory. Is there any possible solution to kind of get some of that inventory off the market in some way that makes sense for taxpayers and for the housing market?
The solution is get the government out, get the free market in, let prices come down so that housing becomes more affordable. The government is trying to do the opposite. Prop prices up so nobody can afford it without a government-guaranteed mortgage. You know, it's the government that screwed up the housing market by supplying the moral hazard. The reason that people can buy houses they can't afford is because the government co-signs the loans. I made that point in front of Congress again because this is the second time I testified. And we have to understand that when real estate prices go down to where they need to be, that's going to expose a lot of problems in our banks. And it might mean that some of our banks are going to fail. In fact, many of our banks are going to fail. We have to let that happen because as damaging as that is to the economy, it's going to damage us more to try to artificially prop them up because then we're going to destroy the dollar and the losses will be far greater in terms of purchasing power.
And if Bernanke raised rates, he wouldn't bankrupt the Fed, given how big their book is now?
Well, you know, that is going to be a problem. The Fed is exposed, too. You know, Ben Bernanke tried to pretend that he can shrink his balance sheet whenever he wants. No, he can't. You know, it's like the Roach Motel of balance sheets. You know, the Fed can check in, but there's no way it can check out because if it tries to sell those long-term treasuries, it'll crush the market, rates will spike up, and it'll have huge losses, which, by the way, anything that the Fed loses, all those losses are immediately going to be liabilities of the U.S. taxpayer. They've already got that agreement in writing. Whenever the Fed loses money on its portfolio, the losses have to be made up by the U.S. Treasury. So imagine the Treasury bailing out the Fed. And, of course, where's the Treasury going to get the money to bail out the Fed? From the Fed.
Just got 10 seconds, Peter. I know you like gold. Where do you think gold goes and in what time frame? Very quickly, please.
It goes up. You know, it goes up. I don't know any time frame, but, you know, obviously in the short run, anything can happen. But I think gold goes a lot higher, not only in terms of U.S. dollars, but in terms of Canadian dollars as well, although I think it'll be a bigger gain from an American perspective. But look, there's no floor on fiat currencies. There's nothing that stops central banks from printing money. But there is something that stops mines from producing gold. It's a lot easier to print money than mine gold. And so the supply of gold is going to remain scarce. Its value is intrinsic. And people all around the world are going to seek it out as a safe haven. So don't believe the media hype that there's a gold bubble. I just say you keep on buying it. The bubble is in paper. That's where it is, in dollars or in euros. You want to buy real money.
Thanks very much, Peter, for joining us today on Market Sense.
Great to have you. Great to have you. Peter Schiff, CEO of Euro Pacific Capital and author of The Real Crash, America's Coming Bankruptcy. And up next...